This is Rod Kusanen, Spooman for Risk on September 23rd, 2009. This is part 3 of a series of videos on our market activity during the day. We're now going to address whether this market activity today constituted the high that we have been looking for in relationship to the future market crash of 2009. Now here's a simple 500 tick bar chart which plotted some of our support levels that we expected to be exceeded as the market dropped off during the day. We left some resistance levels up at the top here, which we expect to get exceeded as well. This chart doesn't really tell us much other than the overall pattern of the day, which was yellow for those of you that know what pattern of the day means. And what I want to show you now is gap data. We talk a lot about gap data. Gaps are always filled. So was this the high that we've been looking for? And should we be anticipating that this crash that we've been expecting is now upon us? To do that, we're going to look at gap data. Now this is the ES gap data chart. Notice where the gaps are as the market moved down. 1075.75, 1073, 68.75, 64.25, and so on. We got all sorts of gaps way back up there at the top of the move. Gaps are always filled. So guess what, friends? Even if we continue to get a sell-off into tomorrow, Thursday the 24th, we've still got gap data up there. And that tells us that the probability is that this was not the high. The market will go back up. We see that data evident because of, we make that conclusion based upon the gap data on the ES. Notice what we see on the VIX. While we've got all sorts of gaps above where we are right now, and that's the thing that concerns us the most. As the market rallied up, as it sold off this afternoon, it left a gap at 22.39. So, conclusion of the matter, it's not over yet. We can expect that certainly there is a greater probability that the market will sell off ultimately than it will continue to rally. Our gap data today indicates we're going to go back up. We got a gap on the VIX down there. We've got gaps back up at 1075.75, I think it was. And one other thing that we do notice about the VIX, when the VIX is divergent, it's very clear. As the market went and hit a high, at least on this chart, you do not see any divergence at the high. The DPO is real low here, but there is no divergence. Normally, when we see a real trend change, we're going to see divergence on the VIX. We didn't. In fact, this implies to us that the VIX could very well go lower than it already has. Lower than 2220. So, is it possible that we hit the high and that this is the beginning? Yes, it is. But if you're a trader taking a short position now, be aware. There's data here that indicates we could be going right back up. When, I don't know. But the gap data suggests that this big short that happened today does not constitute the big move that we are expecting. If you do short and hold that trade, make sure you have a good stop on it. protect your profits on the short. We indicated in one of our other videos that we went back and tracked the last time the market was up at around 1071. And if you go back to our Future Crash of 2009 Part 5 video, you'll see where we found another gap in data on the ES at 1095, I believe it was. It was either 1093 or 1095. So in the light of that, in the light of what we see here, again, we may not yet be right where we expect us to be when this market finally says enough is enough. A great trading day, excellent group reversals, nice short, probably will continue to a degree tomorrow. However, it's possible we're going to go right back up again. So we will see what we will see, and we will trade according to what the market tells us at the time. We enjoy your comments. Please subscribe to our videos if you haven't already. We provide you with a lot of updated, very precise information about market activity, things that you cannot find on any website anywhere other than at RSKsys.com. I'm Rod Kusin and Spooman for Risk.